Hey everybody, thank you all so much for joining us this evening. Before we get started, I just wanted to do a quick microphone check and make sure everybody's audio is coming in nice and clear. If you don't mind, just taking a quick minute to type in the chat box that you can hear us loud and clear. That'll give us the green light to go ahead and get started. So I'll wait till we can get maybe one or two confirmations here, and we'll get going. Let me see if I can go into, good, cool. Thanks guys, appreciate that, very helpful. Awesome. Well, hello everybody. Thank you all so much for taking the time to join our webinar this afternoon or this evening. Looking forward to today's presentation. We're going to be discussing the differences between single family and multifamily. The goal here is to cover high level differences, right? We're not going to get into too many ultra specifics, but basically what I wanted to establish just right away is there's no good or bad choice here. It's simply options and learning about which of those options make the most sense for you, right? So that's the kind of the high level of what to expect this evening. I also have the pleasure of co-hosting this presentation with one of our top Texas agents, Gerard Koladejczyk, who lives in San Antonio. Since we have Gerard on the call this evening, we're going to be focusing a lot of our property examples or all of our property examples in Texas. But I do want to let you know that we do offer our services across the country. We'll go over our markets, but I just wanted to highlight the specific properties this evening are going to be Texas focused. So my name is Vince Tomich. I'm an advisor here at Marshall Reddick, and I have been an advisor here for just about 5 years now. My primary role as an advisor and agent is to learn as much as I can about each investor and to help guide you through the process and answer any questions along the way. I was born and raised here in Southern California. I have been in the real estate industry now for just over 8 years, and I'm a property owner myself. I own single family, I own multifamily. I'm a huge fan of practicing what I preach, right? My background prior to this role is I was a residential lender for a number of years, and that's where I really learned the value of leveraging money and being able to understand the whole finance and the loan side of the business, which I felt gave me a lot of confidence to move forward with my personal acquisitions, as well as gives me a lot of insight to help our new investors or folks that are looking to buy with leverage. And right now, more than ever, having the most creative options and advantages for leveraging your capital is critical. So that's a little bit more about myself. This is always a good time for us to also educate those of you that are new to Marshall Reddick, like who Marshall Reddick is and what we do. So Marshall Reddick is a full service real estate firm, and we focus on 4 primary services. So we have our real estate brokerage. Real estate brokerage, we help people buy and sell, whether it's a primary residence or an investment purchase. We can help in any of those capacities. 99% of the individuals that do end up buying a piece of property that's an investment, they need management or property management, and we offer that service as well. We cover everything from A to Z. So from marketing the property for rent, rent collection, rent disbursement, any kind of maintenance or repair request we would cover on the owner's behalf, all the way up to like I said, dispersing rent, and in the unlikely event of evictions or unruly tenants, we would handle that with you guys as well. So basically A to Z process that we would be able to assist you folks. And our third service is private money lending. So we have a huge part of our business where we do hard money or private money loans. And the typical borrower for those are going to be individuals who are looking to fix and flip a property. Maybe you're a self-employed individual and you have a self-directed retirement account. You may use our firm to leverage capital to buy investment property within your self-directed retirement account. Those are great examples of people who borrow from us. And then on the flip side of that, we have our investment fund, or our lending part of the business. And when I say lending, it's like instead of being a borrower in borrowing money, you have the ability to invest and be a lender or be the bank, right? And there's two ways to do that. You can invest in a direct capacity, one borrower, one lender, and Marshall Reddick would tie you two together, or tie together those two parties. Or if you're looking for something a bit more passive and less involved, we also have a mortgage fund, right, which we manage, and it's a conglomerate of a lot of the loans that I just disclosed to you guys, right? The same comes from the same borrowing pool, but instead of lending or funding one particular loan, you own a portion of the mortgage fund, and you get quarterly distributions. So that risk is spread amongst 200 plus loans, and you have the flexibility of being able to come and go as you please in terms of investing and taking capital back. So I can give you more information about any of those services, but those are the high level of what who Marshall Reddick is and what we do, for those of you that may be unfamiliar. So tonight, topics we're going to be covering, super exciting. We wanted to talk about, top of mind is why invest today versus waiting. What are the expectations of interest rates? We're going to go over multifamily, single family. We'll talk about property management, talk about financing, and then Gerard has some properties for us to review. So that'll be exciting to go over as well. And if we have some time for questions, we will. And just so you guys know, in the event we don't get to questions this evening, I will be doing follow-up calls tomorrow and the rest of next week. And I'm happy to set up one-on-ones to go over any kind of specifics in more detail. Now, before I hand it over to Gerard, I just wanted to quickly cover the markets that we have a physical footprint in. So these are all of the markets that Marshall Reddick has access to and that we operate in. So what you'll notice here, there's 5 states across the country: California, Texas, Florida, Tennessee, and Kentucky. And yeah, we're going to be focusing a lot of the properties. Examples are going to be in Texas, specifically San Antonio. But I did want to give a highlight to other markets we have access to for those of you that may have properties that may need management service, that may be looking to buy or sell in any of these markets. These are areas that we can definitely assist and help you folks out. So without further ado, I'd love to bring in Gerard and let him take it away.
Hello, everybody, and welcome. Thanks so much for joining us tonight. A little bit about myself. I am a realtor and a real estate advisor from San Antonio, Texas. So I know the city, the area, the state very well. My wife and I do own real estate investments in Texas, and we participate in the Marshall Reddick Fund. We have used the private financing to flip a property and hold it. And my background started in the real estate business in the mortgage industry, and which next led to working in construction. I was a senior construction project manager, and all my real estate experience started in 2004. Happily married to my best friend, dad of 3 gorgeous little ladies that keep me very busy. And I guess a little bit about myself is I love to fish, I love to play guitar. And the most commonly asked question whenever I first get on the phone with people is, how do you say your last name? So if you take a look here at the picture, Coca-Cola, Cola, Day for the sun, and Check. So Cola, Day, Check together, and that's how you say my last name. So on to the next slide. So why invest today versus waiting? I can't tell you how many times I wake up or I stop my day to take a look at my phone and another article comes through and says you should not invest today. The best thing to do is wait because the rates are going to go down. We're going to talk a little bit about that today because we want to make sure that the knowledge that we have on our end and the things that we see in real time between the people that are investing, how property management is working, how the properties are selling and the trends. We want everybody to be familiar with the information so you can make a better decision. So talking a little bit about that, it says more inventory, and everybody's sitting there saying, well, all I've heard on the news is there is no inventory. Well, we need to talk about that. The inventory of existing properties, something that's not new construction, there are pretty low inventories there. It doesn't make a whole lot of sense for somebody to sell an existing home right now compared to when the market reaches its next part of the cycle where all of a sudden it's going to become a seller's market again. Currently, right now, it feels like we're very much in a buyer's market. So with that being said, there is a lot of inventory of new construction properties, and we're going to go over some of those today. The new construction properties come with seller incentives, which a lot of times can encourage buyers to look a lot closer at the new construction and sometimes stay away from some of the existing properties. And we're going to talk a little bit about how some of the existing properties can still be attractive. Vince, talk a little bit about the forward commitment. This is something that's pretty popular right now in a way to kind of adapt to the market and still make some of the transactions attractive.
Yeah, absolutely. We actually have an example of a forward commitment property here, and without going into too long of detail, but within conventional lending, there are certain limitations on what a seller or builder can contribute to a transaction. Therefore, in an investment purchase, the seller or builder can only contribute up to 2% of the list price, right? Those are some of those seller incentives that Gerard talked about, right? Whether it's closing cost credits, maybe it's free property management, whatever it is, right? But at the end of the day, the dollar amount that a seller or builder can contribute is 2% of the list price. Oftentimes, the most effective way to use that capital is to take that and to buy your interest rate down, right? That's where we've seen work for the last year and a half or so to help get the numbers to reflect more attractive to our investors. With obviously the recent adjustments in interest rate, that 2% hasn't been enough. So with the participation of our preferred lender, who we're going to be introducing or connecting, showcasing later tonight, with his lending relationships, we have been able to secure certain opportunities where we can get capital from a builder or from another seller ahead of time to buy the rate in excess to that 2% before it is even given to you as an opportunity. So for example, if you were to say that your current interest rate starts at 7%, we have the opportunity to allow a seller or a builder to put in enough capital to start that interest rate at a 4.5% or 5%, right? So that it's starting at a lower price, so that when you have the ability to look at that particular deal, your interest rates are much lower than market, and that's because it's been basically committed to ahead of time from the builder. So it's a way basically for sellers or builders to buy the rate down before it gets to the end retail user. And we're seeing that a lot with new construction, but we've also seen it, the ability for it to be used with pre-owned. So we have one of those examples tonight, and you'll see basically a 10-1 ARM for a multifamily investment duplex is at 4.75. So that's an unheard of rate now, and that's because of a forward commitment. And again, we can go into more of that on a one-on-one, but that's the high level of what that is. And yeah, we're really excited about those opportunities. In addition to that, right, there is the ability to refinance in the future, right? So again, speaking about Reed and CMG Financial, they're offering a rate rebound option, which basically says that if your interest rate improves by 0.5% in the next 5 years, they will do a refinance with no lender fees, right? So they're going to waive all their lender fees, so you have the ability to take advantage of a refinance as the market improves, which in 5 years is a very high likelihood. So they're okay with that, and that's the incentive for those folks that are saying, well, I'm just going to wait. we can go into this also later in the presentation, but the challenge with waiting is that's going to definitely change the market. As you saw, when interest rates were really low, the competition was high. You had to overpay, and bidding was an absolute war. Now you have a lot more time. There's a lot more inventory to pick from, and with the comfort and security of being able to refinance down the road, we bake in that option for you. And then lastly is just buying at a better price now. There's negotiations to be had, whereas a year and a half, 2 years ago, there was none of that, or very limited of that. So now we have that opportunity to be more in control of a transaction with the seller and to negotiate a bit more on your behalf. So those are all some of the reasons why a lot of our investors are moving forward now. Gerard, if you want to kind of give a quick insight of what our conversations with Reed were recently and his expectations of interest rates.
Absolutely. So Reed Hazard with CMG, some of you may already be familiar with Reed. He's a preferred lender that Marshall Reddick has been using for many years, and was actually rated, I think, number 64 in the nation as far as loan officers. Vince and I both come from the financial institution background, and it's unique to find some people like Reed that just never accept that he can't go out and try and find a better situation for borrowers. When you get on the phone with Reed, you'll understand his passion. It feels like just the first 5 minutes of the conversation, like you drank a cup of coffee and you didn't. You're just talking to Reed because the energy he brings. Well, he also brings that kind of energy when he's helping. And we frequently reach out to Reed to get market updates. And I know everybody right now is just looking everywhere for market updates. Here's a great one by Reed that's really going to follow in line with the advice that Vince and I are giving you today. I'll go ahead and read it to you. It says, interest rates have been at 20-year highs, but are starting to ease, much like we saw through the end of 2022. We believe the inflation resurgence as we move into 2024 will be lighter than what we experienced in 2023. The economy is still strong, but things are falling back into balance, and the Fed will likely bring rates down in 2024. Until then, now is a great time to get a good price. And we provide a no-cost refinance in the future through our Rate Rebound program Vince was just discussing at any time in the next 5 years. This way, you can take advantage of today's prices with tomorrow's interest rates. So let's talk about that a little bit. The common misconception that Vince and I hear quite a bit is, I'm going to wait until the rates go down. And that's perfectly fine if that's what you're comfortable with. Our job is to kind of talk you through another option and a different way of thinking. So we'll provide some information like, well, when rates do start to come down, you'll probably read all over the news and through a lot of resources, they feel like a lot of buyers are going to come off the sidelines. And when we have that kind of demand, like we saw in 2020 all the way up till 2022, certain things start to happen. With the demand going up, so do the prices, so does the competition. Right now, if you're purchasing, you have a lot less competition. I'm not seeing any or very few price wars, as Vince mentioned earlier. So we're in a very comfortable market right now for the buyers. And so it's one way to think, hey, I'll wait on the rates, but the other thing is to say, well, if I wait on the rates, the price changes. So as one of my lender friends in San Antonio always says, he says, date your rate and marry your price. So if you think of it that way, somebody who takes advantage of the price during this market and later on is able to reduce their interest rate through refinancing, and also as you go raising rent prices when you can, then that person to me wins. And we'll talk more about that as we go on. Okay, so why multifamily? We're going to talk about multifamily. We're going to talk about single family, but let's talk about that a little bit because there are some advantages to multifamily. One, economies of scale, just like anything else. Multiple doors and multiple rents growing at the same pace. Price per door substantially lower than single family residence. And again, make sure when you're comparing that you're not comparing maybe two different, like in San Antonio market is a little bit different than the New Braunfels Seguin market. Sometimes when we're comparing those two, we have to realize that there is a difference. Less competition, less buyers are out there chasing multifamily deals versus single family higher price point entry. As of now, quite a few people I'm seeing come through and purchase single family residence homes right now for investment purposes. And I'm seeing less people come to the table to buy multifamily. The good part about that, the builders are recognizing this. We're going to talk about the incentives that these builders are giving. There's incentives coming for the multifamily from the real estate side, from the lender side, and from the builders, and it's really making it a lot more comfortable to purchase these right now. Higher cash flows. Anytime you have multiple doors, it allows you more cash flow, more insurance of income for owners. If you have two doors and one side vacates, you still have income coming in from one side. So it's one way to think about, hey, you know, it's better to pay half a bill for a month than have the entire single family residence vacate. So there are benefits for using multifamily versus single family. So here's an example. These are actually, we didn't even plan this, but this is an average that we use. And two of our examples almost perfectly mirror this. When you're thinking of economy of scale, on the left side of the example would be a fourplex. So the purchase price about $850,000. The example we have here is a 2017 build, so still fairly new in this price range. Numbers of doors are 4. Price per door, $212,500. Gross monthly income, $6,000. Square feet, 4,980. Properties to maintain 1. So that's the fourplex. Now let's compare that side by side to the single family. Purchase price, $305,000. 1 door. Price per door, $305,000. Gross monthly income, $1,850. Square feet, 1,440. For this price range right now, we can even get up into like $1,750. Doors needed, 3.24 to be able to match the 4. Equivalent cost, $988,200. So as you can see, comparing side by side, there is a difference between single family and the fourplex and the economy of scale. Next up, let's come. Oh, go ahead.
One thing I wanted to add to that, Gerard, is, you brought up a really good point, which was income reliability. Like you said, if one unit it vacates, or one tenant, you have a vacant unit, you have the other side to help offset, right? So you're spreading your risk amongst multiple doors. One example that I always like to bring up is I own a small duplex in New Braunfels. So that's right in between San Antonio and Austin, Texas. And when I purchased the property was just breaking even after all the fixed expenses. So basically rent from both units was just covering the fixed expenses needed. That property was a bit behind on market rent. So what was nice is after acquisition and being able to increase those rents, I increased it at a point where I knew that it was just still below market and the tenants probably weren't going to move just based on what market's price were. So a property that went from breaking even went from $150 increase times 2, right, to 2 doors. All of a sudden cash flows $300. So that's something just kind of immediate. And those incremental adjustments times 2 doors, right, that actually does start to create a much greater net effect to me. And that example is amplified as the amount of doors are increased, right? So I think that's a really good way to help increase cash flows quicker, is by having multiple doors and doing smaller increments along the way. So just kind of a live example of economies of scale there.
That's a great example. One other point that comes to mind, Vince, is when you're trying to sell a multifamily or any kind of investment property, if you have a single family home and you're trying to sell it to another investor with a renter in the home, a lot of the investors or their agents, representatives, want to see the home, and it's not, I guess, it's not likely that you're probably going to do a showing with a renter in the home because, first off, it's not staged properly. And on top of that, you know, you don't want the tenant to start feeling like this is invading my privacy and they leave. So the nice thing about having a multifamily, if you have a duplex or a fourplex, is you can actually start, if you plan to sell it, you can plan to sell it when one of the units vacates. And once they vacate, you can set that up for showings, and you can say, hey, I've got a duplex, fourplex, come take a look at one side. Typically ends up selling faster. So that's another thing. So great point, Vince. Here it talks about less competition. Less buyers are seeking multifamily opportunities. A lot of this has to do with, you know, the amount of cash it takes to close. You might have some people who are starting off investing, or maybe it's just their strategy. All they want is single family homes. Not a problem. We can work with anybody's strategy. Takes a more experienced investor to assess and mitigate the risks. That's what we're here for. This is what we do every day. We work in the process from, you know, this is nice that we have these webinars. It's great to be able to connect with people, but during the day, we're doing a lot more than marketing. We're meeting with these builders. We're having conversations with builders. We're checking their work. We're going in and seeing their properties. Builders are actually coming to us to talk to us about what we're doing because of the fact that we're able to help some of the builders move these properties. We're helping the investors get in. We're helping the tenants get in, to help the buyers, you know, fill their properties. We're on all different angles of this. We are also coordinating with the builders, with the lenders. We're going to see some examples of those here in just a little while, but we understand all parts of the business, and we want to be a resource for you to be able to help you understand that. We're going to be your boots on the ground. I'd say probably 90% of the people who buy from me don't even come to San Antonio to see the property. So that really takes, you know, some agents that are dedicated to be able to not only go out there and do the video for you, but be involved in things like what's the punch list before this finishes if it's a new construction, or, you know, I'm going to be out on site with the inspector just to take a look. So when the inspector explains something to me, I can, you know, speak to it, and we can have a conversation that's going to make you feel comfortable. Some of the people on the webinar might be local, and you know, again, happy to show you, happy to meet you, talk through everything. Come by the office. We'd love to have you. We love to have people coming in from out of town always. So it takes a more experienced investor, but it also takes a more experienced agent and team as well. Limited supply in many markets. Again, you know, we're fortunate in San Antonio that the Census Bureau calls us the third fastest growing city in the United States. So we have a lot of builders. It's our job to go in and vet these builders, to take a look and make sure that quality product, that their warranty, they're honoring their warranties, but really just their team, they're part of our team. So we can't work with a builder that's not going to, you know, produce a good product for us that we bring an owner into. As we talk about property management, we have skin in the game. We don't even charge a management fee until we have a tenant in your property. There's companies out there that charge a management fee while it's vacant. What incentive is in it for them to, you know, to put a tenant in there? They're getting paid anyway. We don't do that. Higher end price point. There's less competition because it takes, we'll take a look at the numbers at a summary a little bit later, but it does take more to get into the multifamily. So higher cash flows. General rents range for a 3-bedroom, 2-bath in a specific area, be applicable for both single family and multifamily. More doors, again, economies of scale, equates to more rental streams and improved cash flow. Income reliability, just like we mentioned earlier, when you have 2 units, if one vacates, the other one's still there. And we have a very good track record of keeping properties fully occupied, multifamily. Rent increases are multiplied per door. So let's take a look at an example here. Looks like some of this got moved over here a little bit on the screen. Let me talk you through this. Okay, so single family upgrade. Let's see here. There's a single family upgrade and a duplex upgrade. So we're talking about a single family that's more of an upgrade. term them as like an upgrade or basic. So both of these will be upgraded. The single family upgrade, the rent is $15.95 a month. And then we have, I'm sorry, $18.95 a month. This is going to be a little confusing, but I will talk you through it on the slide. Single family is actually $18.95 a month. And if we consider that with a 5% rent increase, that'd be $95. And then the new rent would be $19.90. Cost per unit is $303,000. So let's take a look at the duplex upgrade. And this is actually $15.95 for unit 1, $15.95 for unit 2, $3,190. And a 5% rent increase gets you $160. So again, economies of scale. You go up $95 a month in the single family, you go up $160 on the duplex.
And this speaks to the example, Gerard, that I was kind of giving earlier, right? Is just, applying that increase per door and how that can be, how that can even be increased, obviously, as you get more doors. So something to just kind of visualize that concept there. So that was a good job. I know that the lines were a bit confusing, but they totally understand the ideology there.
Right. So again, there your new rent after you do the increase, $1,675 plus $1,675, $3,350. Cost per unit $272,500. So you can see, just comparing the cost per unit on the single family versus the duplex, it's just like a lot of other things. When you purchase more in quantity, you get a discount. So we do have some great examples there. We'll go through that. Again, apologize that we had a little glitch there on the slide, but what I'm really looking forward to as we go through this is an introduction, as Vince said. We can't wait to spend a little time with everyone and find out, first off, why are you looking for an investment property? Are you a seasoned investor, or are you just starting out? Talk about your strategy and see what how we can help. So we're gonna go ahead and move on to single family. Talk a little bit about that. Why single family? And again, you're going to have a strategy based on your situation. If you don't have a strategy, Vince and I are happy to talk you through some suggestions and see if we can make something that will help you get started. Affordability. So when you're looking at single family, more affordable when comparing multifamily properties, and similar and easier to maintain. Appreciation. Single family homes tend to appreciate. It's not a huge margin, but they do tend to appreciate a little bit faster than the multifamily. Easily tradable. Single family homes are the most tradable real estate asset. They're purchased in both primary owners and investors. I'll give you an example. If you know that you have a tenant that's going to be vacating and you are sure you want to sell the property, at that point, as a realtor, I'm going to suggest to you, have the person vacate. Let's go in there and we can have the maintenance team take a look and see what it's going to take to make the property ready for sale and showing. And we can market it. At that point, you can market it to investors and you can market it to primary homeowners. And chances are you're going to sell that home a lot faster. So it's just things like that we look for. They are easily tradable. Multifamily, most of the time is pure investment. But we do have scenarios, and Vince, I'm seeing this a lot more right now, where I have people that are wanting to purchase, and most of a lot of them are moving in from out of state, and they want to purchase multifamily, but they want to occupy a unit. That's also something that can be done. We're going to talk about in a little bit that there is a new change coming down from Fannie Mae that is supposed to go into effect early next week. So if any of you are considering purchasing a multifamily property to be able to live in one side, occupy one side, this is very important that we get on a call next week to talk about the changes that are happening. In that case, I would set up the meeting and see if we can bring in Reed Hazard to talk to us a little bit about it. There are some fantastic changes. Vince, correct me if I'm wrong, on the conversation earlier, he said that if you're occupying it, you could put as little as 5% down.
Yeah, that's correct. That's going into effect on the 18th, so that's Monday. And I think it's a great way for those that are local or those that are interested in trying to grow a real estate portfolio in the market that they live in. I actually did that here locally in Southern California. My wife and I, about 4 months ago, purchased a duplex here in Southern California, and we occupy one of the units and we rent out the other. So I'm a huge fan of that. That's something that you're going to note between Gerard and I, is a lot of this is we do practice what we preach. We we're clients and investors first. We do work here at the company, but it is something that is exciting, and that a lot of folks are doing, actively participating in some of these ideas, which is nice to be able to talk to you folks about. So yes, you are right about the 5%.
All right, we'll talk about affordability on the single family homes. Lower investment capital needed, lower price point, less down payment on investment properties, minimum that you can put down for the most part, 20%. I believe on multifamily, it's going to be 25%.
That's correct.
And that's 2 to 4 units, 25%. And keep in mind, when we're talking about multifamily, sometimes terms get traded around. Multifamily between 2 units and 4 units is still considered residential when it comes to financing. Anything 5 units and above will be commercial. So keep that in mind. Commercial rates tend to be quite a bit higher than residential rates. There's a whole lot of different aspects that we can talk about if we get on an individual call. If you have any questions, we do have properties that are 5 units and above. We have a lot of success with 2 to 4 units. So there's less down payment on a single family, potentially less maintenance costs, and easier to manage.
And Gerard, one thing that I'll just mention, since you brought it up, is the down payment. So as you mentioned, single family home investment purchase down payment is 20%. What we're noticing though is those higher down payments are like 25 or 30, are getting those better interest rates, lower loan amounts which helps the property cash flow a bit more. And in that same vein, it's applied to multifamily. So the minimum, as you said, for multifamily is 25, but that additional 5 or 10% down, making it 30 to potentially 35, could also improve interest rates as well and lower that loan amount. So that's something that you might see on our calculators, just to let you know. There are minimums, but our default's set a little bit higher, in case you're wondering if you're looking at the website.
Yeah, and I think that's why it makes it so attractive with what we were talking to Reed about today, with that new change coming down the pipe from Fannie Mae, is if somebody's already paying $2,500 in rent, $2,000 in rent, $1,500 in rent, when you look at occupying a unit and you only have to put 5% down on a multifamily, that's, I think, why it makes this so interesting. Is, there are some opportunities there for, I'm talking to a lot of young military people that are coming in. They're getting advised by people in the military to look into that. And, it's a great way to start and say, hey, I'm not only going to purchase my first home, but I'm going to purchase something that I can rent out. Somebody can help me pay the rent on. Anytime you're appreciating at something that's $400,000, $500,000 versus 250, again, here's the next slide, appreciation. Of course, we're talking about appreciation for single families, but, so appreciation with single families, more transactions that create more comparables, driving values up faster. There is something to be said about this, that when you live in a city, there's only so much land that is zoned for multifamily through economic development department, and builders are always looking for land that they can either rezone or is zone multifamily. And you get a lot of developers that go out and just develop this land and just wait for a builder to come in and pick this up. But this land all over the U.S. is getting swallowed up. So, I'm hoping that the trends I'm starting to see, and hopefully we see some more of it, are that the economic development departments are kind of loosening up a little bit, because there's a housing shortage across the U.S. San Antonio is no exception to that. And when more properties open up and they can zone some more properties for multifamily, then you help work on that, some more affordable housing. So bigger buyer pool when listing a property for sale. That's true. Again, we talked about it's a higher cost of entry. So you're going to have more people. It's going to be more affordable for them to buy a single family. Primary residence buyers are willing to pay for more for their personal home. Most homes are in master plan communities in the Texas market. So easily tradable. Let's talk about that a little bit more. Most common type of residential real estate is single family. Purchase option for both primary residence buyer and an investor. We talked about that earlier as well. When you're trying to sell, it might make sense to open it up to both different types of buyers. They make up 69% of home sales. The majority of the housing stock in the United States, single family detached houses. Of the total 128.5 million housing units in 2021, about 81.7 million were detached homes and 8.2 million were attached single family homes. In comparison, roughly 31.8 million units were multifamily buildings. So single family versus multifamily financing. Let's talk about that. We talked a little bit about the financing. We'll get into a little bit more on the down payments here, but single family, 2 to 4 units, as we mentioned earlier, that's what you're going to consider residential. Down payment requirements, 20% to 25%. Typically what you see here as far as the types of rates that you have a 30-year fixed. A lot of people, especially in the primary sector, you have a lot of people that want 30-year fixed. It just gives them that comfort of, if they get a great rate and they're happy with it, their payment's not going to change. You got a lot of fixed income buyers that say that they want to do that. Adjustable rate mortgages, we frequently in our business call them ARMs. You'll see that tossed around quite a bit in that term. The 10-year ARM right now is a product that a lot of investors have been comfortable with. And Vince, when you think about the cycle, real estate, and you look on our website as we take people through and we have a chart and a graph that takes you all the way from 1989 and the appreciation in the areas to current. And we go through that to explain that and just reiterate, because everybody knows that real estate is cyclical. So we're in the cycle part right now of where rates are higher. It is a seller's market. Transactions are down. That is going to recycle back up. A lot of people are saying 2024 is going to be the start of the other end of the cycle. We hope that that's the case, and homes are easier for people to purchase. But that 10-year ARM, most of what I see on that chart, Vince, is probably between 6 and 7 years. You're seeing the cycle go full circle.
Yeah, and being in the loan business too, in researching this a little bit more, the average hold time for a 30-year fixed is 7 years. So if you think about that, it's not necessarily that means people sell in 7 years, but that means that there is some event that does change that 30-year fixed loan term. Oftentimes that is a refinance, right? So a refinance would totally adjust that, and you would throw away whatever, or should I say adjust whatever progress you made on that 30-year fixed, typically for a lower rate, maybe even for a cash out, right? For those of you that purchased 2+ years ago and you've experienced quite a bit of equity growth, I'm sure you guys have tapped into some of that equity or may have considered it. And that's something that's pretty common whenever rates do adjust. So the likelihood of, and also selling a home within 10 years is not, an uncommon stat either. So I think, when you're talking about adjustable rate mortgages, sometimes that term could be, people may want to stay away from them. But when you think about actually the time of that fixed period, that means for 10 years, the rate is fixed. And then usually every year after, or every 6 months after, starting on after year 10, it is subject to adjustment. And that doesn't mean you have to stay with this loan indefinitely. Oftentimes what people do is they take a 10-year adjustable rate mortgage to the end of its fixed term and then refinance. And typically that 10-year term, you're going to find an opportunity to improve that rate. So I would agree with you in terms of the timeline allotted on that ARM. They go from 3, 5, 7, and 10. So I think that 10 is pretty conservative.
Yeah, and I would definitely say too, Vince, that from a lot of the resources that I've been working with, that 7-year average hold is expected to be double pretty quick. In the next 20 years, they're expecting people to probably hold between 15 and 20 years. A lot of that has to do with the fact that people on some of their investment properties have 3%. And if they're going to take cash out, if they can do it without refinancing as a whole, hold on to that rate, it makes a lot of sense to do that. So we're going to see some changes there, but the trend is that people are going to start holding these longer, which is why you're seeing a lot of people interested in the new construction. So finishing up on the single family side here, more favorable terms for the borrower. You know, anytime, especially like we mentioned, it's going to be residential versus commercial. That's the big, you know, point to take away there. Less discount points, which is money to buy down your interest rate. Longer fixed terms, no prepayment penalty. And then now let's look on the right side here, multifamily financing. Multifamily is 5+ units, more down payment, 25% plus, more loan products, adjustable rate mortgages, ARMs, interest only payments. You might take a loan out and for 10 years, you make the interest only payment on it and you're not paying down your mortgage, but you are paying the interest down, but the property is appreciating. The DSCR as well. We talk about that if we need to. I don't know that we'll get into that too much. More loan costs. There's higher points that go into a transaction with 5+ units. Less favorable terms and early payoffs.
Yeah, and Gerard, just to kind of highlight here again, you know, what we're, like you said, the key takeaway here is the conventional guidelines are subject to 1 to 4 units. So there is a huge advantage in that conventional guideline space because it is more favorable terms to the borrower, and to be able to apply that to multifamily is pretty special. Whereas as that 5th unit, as soon as you get to that 5th unit, you're just following a new set of guidelines. And like you said, it is the conventional space where like the 30-year fixed is not a common feature and oftentimes not applicable. You are going to be exclusively working with ARMs and just more aggressive type of products that are not as favorable. So for those that are obviously in that space and understand that space, that's fantastic and that's great. And we just wanted to highlight that. It doesn't mean that we can't help you with obtaining those properties. It's just kind of highlighting the difference there. But for those of you that are just maybe getting started or trying to start and grow a portfolio, it is advantageous to take advantage of some of the favorable terms of conventional residential financing. So,
Great.
I'm gonna just the man, the myth, the legend, right? We've been talking about Reed Hazard through the evening. Reed Hazard again is with CMG Financial. He's our preferred lender and has worked with us for many years and is a great resource. I'm sure there's folks of you that are on the call that have met him and have gone through the pre-approval process. This is someone that we like to refer our business to, as he's licensed in all of our markets. This company's licensed in all 50 states. So if you do have a question and it's maybe pertaining to a property that is outside of our network, but you already own it or need some questioning on for financials, Reed is a good go-to person for that. And as far as things that we wanted to highlight, I just have here a quick kind of loan, some baseline loan amounts here. These are the conforming loan limits, and this is the high balance loan limits over onto the right-hand side. So you'll see, you know, as you go from a single to multifamily, those loan limits really go up, and they're going to be going up again next year. And the reason that I point this out is just so you guys can see the ability of what kind of price points you're looking at to kind of stay within, because once you exceed the high balance low limit, by the way, is only exclusive for particular areas. So that column that you see on the right, for example, you might find if you're here in Southern California, right, there's tons of high cost areas, basically almost everywhere, you know, LA County, Orange County, San Diego, these have high cost areas. So therefore you're going to be subject to a little bit of a different conforming limits. But for most of the investment properties and across the country, you're going to kind of stay on that left side of the column. Once you go above that, though, you're considered into jumbo financing, which typically has a little bit more aggressive, or should I say, restrictive terms that you might need to be aware of. But one of the things that we did touch on it earlier, one of the highlights is the new loan program of being able to put 5% down on a multifamily that you plan on occupying. So this is a 2 to 4 unit that you plan on living in one of the doors. You can put as low as 5% down. And the second item that I did want to touch on, which we did cover a little bit earlier, is that rate rebound. Being able to refinance with no lender fees within the next 5 years, if interest rates improve, is a great tool and a great resource and feature that Reed's team is offering. So we'll be able to send more details on that if you guys are interested, or even if you have purchased in the past with Reed. This is something within the last 2 years at least, this is something that it can be applied to. So that's a little bit more about the financing. I also wanted to talk a little bit more about property management, right? We usually spend a little bit more time on property management, so I wanted to at least cover a little bit about that with you guys here tonight. So as I mentioned, what does property management actually do, right? So there's a lot of folks that when it's going really well, there's the assumption of, I don't know if I need a property manager. I don't know if I need to pay this fee. I would highly encourage those of you that are interested in scaling or that don't want to take on a full-time job or responsibility to really explore and be open to the idea of property management. I've highlighted some of our fees here just to allow you guys to get an understanding. So there's basically a pretty straightforward fee structure. We have our monthly management fee, which is typically going to be about 8%, depending on the unit count, right? But typically most of our individuals fall in that 8% range. There's also a 50% leasing fee. So what that pays for is that pays for the efforts of the leasing agent when a property is vacant. So when a property is vacant, we have to procure a tenant. There's going to be showings, background checks, screening, the move-in inspection, the moving in of the tenant. That is what 50% of the first month's rent. Okay, so you only pay that upon filling vacancies. That's not on an annual ongoing basis. So if a tenant stays for 4 or 5 years, you've only paid that leasing fee once over that 4 or 5 years. We do have a lease renewal fee of 15% of the lease, and that's paid to that goes to our managers who walk the property annually and do an inspection, and that really avoids long-term major expenses or fixes that need to be done to the property. If you're constantly maintaining it and reviewing it or inspecting it every year, you avoid this deferred maintenance situation that some people face when owners or managers haven't been to a property in 5 years. When the tenant moves out, you think you gave them a brand new house, and when you go in on year 5, you basically have to demo it all, right? So we're trying to avoid that situation, and that's what the lease renewal fee covers. But the real nuts and bolts is we want to make sure we know the rental laws, right? And we're doing the proper disclosures. Ultimately, our job is to keep you out of court. There are a lot of places across the country that are very tenant friendly. Most of the markets that we operate in are much more landlord friendly, which is a huge advantage. But that's our goal, is to follow the law, keep you out of court. And a nice feature is we only make money when you make money. So the reality to that is when the property is vacant, we're not charging a management fee, which there are management companies that do. And then we have outside vendors that do all of our maintenance. So we don't have an in-house maintenance division. And for those of you that are thinking about that at face value, that could be considered a positive or a negative. And I have personal experience with that, where some of the properties I've purchased in the past outside of our markets, I've had property managers that have internal maintenance divisions, and that is a profit center for them. So when things break and they need to fix it, there is an upcharge to that. That is a way for that company to make money. Whereas with us, we source out all of our vendors. We will directly get invoices from those vendors and give them to you. If you're not happy with that invoice or like to look at another price, we're more than happy to, as we do not profit in any way on repairs. We also have awesome software through AppFolio that allows to track all the property details, the lease info, the financials, everything that you need to know about your property. So we highly recommend considering this as an option, and we'd be happy to talk about more of the ins and outs if anybody is interested. I'll let Gerard kind of go over some available properties that we have.
Great. Okay, so on the available properties, we're going to just run through some of these, and then we'll get to a summary sheet that'll kind of talk us through everything. But let's talk about some of the areas we have here. You're going to see 4 yellow and then 1 red. These are the areas of San Antonio, kind of on your bottom left corner there. There's San Antonio. All the way up to the top right, you're going to see New Braunfels. I-35 corridor is a big reason why people invest in San Antonio, and anywhere in between San Antonio and Austin. San Antonio and Austin are becoming a mega metro, and people want to be investing in the areas that are going to be booming. New Braunfels in the Seguin area are very attractive because they're right in the center of San Antonio and Austin. So you get a lot of these big companies that are basically coming in and saying, I want to pop up right in the middle of Austin there and San Antonio so I can feed talent from both cities. So that's a little bit about the location. We'll come into the next slide, property tax cut. Won't get too much into this. Happy to talk more about this when we're on a call, but our governor has really done some amazing tax cuts. Just Google it, take a look at it. Some of the incentives are helpful to investors, and quite a few incentives for primary home buyers, so primary residents. So definitely want to look into that. And let's talk a little bit about some of the examples here. You'll see on the right there, we've got some items in green highlighted. Here's a single family. I call this a basic. The cost of entry on something like this, if you see on the right side here where it says investment capital needed, it's going to talk about the price and give you your costs up front. Initial repair costs in there are $4,500. This is a home that you're going to need to do a little bit of work to get it rent ready. So with that one, you'll see you go down a little further, gross rent. This is looking at $1,595. In green there, you'll see that we highlighted the management fees. And the reason we highlighted that is because as a real estate company, we feel that there's certain things that we can do to help people in times like this as well. So we're offering currently right now 12 months free management fees. So if you took that negative number that normally would come out, we're doing that for the first 12 months once you get a renter in there. If you use us for property management, you can take that amount and you can add it to your cash flows. Go a little further down and under fixed monthly expenses, and you see the next green box and it says $2.79. Well, that's not a lot of cash flow, but I can tell you right now, it takes creative people to get you to cash flow in this time. So if we're taking that 114 plus the 279, that is a positive cash flow, which is great. We, in most of the examples, we didn't take it out just because of the fact that we want you to know, hey, this is what's gonna, happen. But again, if you refinance a year later, 2 years later, if you raise your rents, there's a lot of things you can do there that'll help the situation look better. But every investor I talk to right now is trying just to break even. And there's a lot of real estate agents out there that may not know how. We're helping a lot of agents that come to us because we have the properties, and we're helping them with their clients as well. We do our best to figure out how to adapt in this market. So if you go to the bottom there, you'll see some more information. I'm not going to talk through each one. We'll go on to the next single family. So again, this is a basic. So the next one we're going to, go ahead.
One
Vince.
quick thing, Gerard, just to highlight there. We have extremely I think, compensated for some of those maintenance and vacancy, right? We have 10% maintenance and vacancy on new construction. The reality of this is you're looking more of like 5% maintenance, 8% vacancy on some of these. So I don't want people to be thrown off by some of those estimated numbers. We'd be happy to dive in and show you some examples of maybe properties how they've performed over the years, and you'll see that those variable costs that we call them at the bottom are very much on the conservative side. So just something to point out, because I know when people look at these some of these negative figures, there's a lot of questions about that, and I just wanted to highlight that point.
That's a great point, Vince. And we'll talk about that in more detail when we get on a call. We'll talk about the fixed expenses, the variable expenses. Variable expenses are great to think about, and there's not a lot of companies that really advertise in their numbers and talk about the variable expenses, but we do everything we can to try and make everything as transparent as possible. Moving on to this next single family, this is more of an upgraded single family. This is a 2-story. And you'll see down here, just under the picture, you'll see where it says 3.8% annual appreciation. That's for Seguin, Texas. That's pretty similar to San Antonio. As we get down to New Braunfels, you'll notice that'll be a little bit higher. But looking back on the right side here, the cost of this home is $303,000. I'm just going to touch on the key points. Investment capital needed with assumed closing costs, and this assumed closing costs also, we'll talk about if it includes any discount points on our call. I'll go forward with it, but also the gross rent on this one, $1,895, management fees $136.44, and again, add that back for the first 12 months, coming down after fixed monthly expenses. Oh no, Vince, negative $50. Well, the good thing is you have money for the first 12 months. And again, we're expecting rates to go down. We're trying to help you through this period. This is a great investment in an area that is seen as very attractive as the mega metro of Austin and San Antonio come together. We can talk about this. This house has a lot of upgrades to it. I mean, 2-car garage, 2-story. There's a lot of positives here in an area in Seguin that is very popular right now, just outside of New Braunfels. Go on to the next one. So the next, we're going to talk a little bit about single family, give you some numbers there. Let's see, there we go. So on the, I'm sorry, the multifamily. See if I can get it to the next screen. Next screen. There we go. Okay, and it's going to speed up on me now. Go figure. We'll get back to it. So the next property is going to be a multifamily, but it's going to be a basic. And I promise I will get back to the right one, but we'll start talking about the basic on this one. So this is in Seguin. As you can see here, there are no garages, but this is a great cost-efficient duplex. Total cost $419,000. Builder has some great incentives on this one. Investment capital needed $142, $564.75. Management fee is in there $184.83. So first 12 months, add that back. Monthly income is already a positive at $90.02. So you're going to be over $200 positive on this, is what we're estimating. And at the bottom, you'll see there, if you held this 15 years, your return on investment's about 14.8%. Now take a look where this one is located in Seguin. Go down further under the picture there. This is at a 4.3% annual appreciation, which is higher than the 3.8% in San Antonio and the other Seguin property. So the next property is going to be this. This is a, let's see here. We're looking for the other duplex. There it is. So 432 Emma Drive. This property, there are 3 of them right now, only 3. The builder has done a forward commitment and have put in a large amount of money to purchase a block of interest before the offer. So if you'll notice on the interest rate that we have here, it's at 4.75% on a 10-year ARM. So in this case, we, just to show you on this one, management fee we took out just to show on this one, again, first 12 months only at $0. If you look at the monthly income, it is $261.25. So we can talk a little bit further on that, but this is a great opportunity on a rate that is probably one that you could hold for the 10 years. If the rates change, you can do that. But look at the bottom, 15-year annual return on investment, 17.95, almost 18%. Again, over here on the side under the picture, 4.3%. This is a fantastic opportunity. Right now, this is something very special. There's 3 of them available, and we just released this one, so we're happy to get the webinar in on this one. We'd love to talk to anybody who's interested. And then we're going to look at one other property here, which is a fourplex. The fourplex property, this is a 2017 build fourplex. This is a fantastic property Marshall Reddick already manages, and our owner is selling the property. As you can see, it's a gorgeous property. Looking on the right side there, price is at $849,000. We go down a little further on the management fee. The real estate side is saying, we really want to take care of somebody who has, we really want this property back in management. We would love to hold on to it. It's been a great property. The rents average almost $1,500 per unit. It actually comes out to $5,985 for all 4 units. Fantastic opportunity. The monthly income there is $49.53. Look at that. If you had 12 months of adding back on that 7% there, $377, you're over $400 on your cash flow on this, and the opportunity can just get better. You're looking at this one, the rate's at 6.25. If you do this transaction with Reed Hazard and he has that ability to go ahead and refinance later, this is a great opportunity as well. This is one fourplex that we have, and again, we'd love to keep it. So moving on, let's just kind of put all this. I gave you a lot of information very quickly. I have a summary here that we're just going to run through. Featured property summaries. The first one there, what I want you to kind of pay attention here is incentives. It's going to talk a little bit about incentives here. Again, the fourth one down is the duplex that we talked about in New Braunfels, 4.75. So that one says special builder incentives. Property types, it's going to tell you if it's a single family, a duplex, or a fourplex. It's going to tell you if it's a basic or an upgrade. Location, it will tell you what city it's located in. Cash to close. We have a lot of investors that come to us right now and they say, I have enough for a single family. Great. Happy to help you with that. When the market turns around, we're going to do what we can to help you turn that single family into a duplex, if that's what you want to do, or buy a second single family. But any time to enter the market, there's no better time than right now. You've got the opportunities, you've got all of the incentives. So cash to close ranged from $81,000 for the single family all the way up to the fourplex at just under $270,000. Talks about the estimated profit. You're going to see the one that really shines on this one. And again, none of these are bad. What does your budget call for? So I advise you to kind of take a look there. I'm going to go ahead and pass it on to Vince. And thank you guys so much for your time.
Awesome, Gerard. Thanks so much. And guys, I know we've gone a little bit over. I just wanted to let you know that you can find any more of our free educational videos, articles, or guides on our website, marshallreddick.com/learn. Feel free to review some other webinars. I'm happy to send anything to you guys. Being that we are going a little over, we're going to hold off questions until my follow-up calls. And as a reminder, I will be doing those follow-up calls starting tomorrow and through next week. So again, we're very thankful for you guys, and we really appreciate everybody joining. I did want to give you guys my contact information. So for those of you that were interested in, you had more questions, or there was a property or something that you saw that, prompted some more follow-up, please don't hesitate to reach out. My contact information is below. Also want to thank Gerard very much for taking the time this evening. It was, it's always great to have a local talk about local property. So thankful for your time and all your efforts, and thank you everyone for joining this evening, and I hope everybody has a great night.
Thanks, Vince. Thanks, everybody.